Yeah.
One of his co-authors is here,
Yeah.
Mr. Chang, and the other one's speaking in the business school, I understand.
Yeah, exactly.
So he's going to tell us about market concentration under central clearing.
Okay. Perfect. So let me start. Let me first thank all the organizer for putting together such a nice event. I mean, I think it's a great idea to have a workshop like that with several different topics related to systemic risk. And want to talk today about a project dealing with market concentration or central clearing. And this is joint work with Alan Cheng, who is a graduate student working with me, and he's also here in the first row. Yeah. And Sriram Rajan, who is working at the Office of Financial Research, and is also in the area, but in another conference in Cambridge. And let me start discussing like what we do. And so we have seen already, or we have heard a lot of talks today, at least 2 talks, dealing with central clearing houses. So by now, I think most of you are familiar with the main idea, but let me restate it. What we have is a central clearing house, which is the CCP, which intermediates trades across different entities, which are the clearing members. And I mean, this has essentially been mandated by financial regulations, the Dodd-Frank Act in the United States and other regulations in Europe, which requires trades to be intermediated through a clearinghouse with the idea of reducing counterparty risk. Main idea is to reduce counterparty risk by bringing all the credit risk from like the clearing member to the CCP. But what we will really focus on in this talk is not much on the CCP, but more on the clearing members. We want to understand what happens to the asset value process of the clearing members as they are required to trade through the CCP. And the main goal, in fact, is precisely to develop a model which can give us the asset value dynamic of the clearing members. So that's what we want to do. We want to see if we take into account that clearing members are trading or partly trading through the CCP, what would happen to their asset value dynamics? How will their asset value evolve over time? And the goal is to then develop a model which we can actually take to the data. So we want to essentially estimate the model parameters against real data that we will see at the end towards the second part of the talk. And then we want to make predictions about like systemic risk quantities such as the market concentration. What would this quantity be or how it will evolve under a central clearing structure of trading? So these are the questions that we want to answer. The main goal, and that's why I wrote clearing members large, is because we want to focus on clearing members. Okay? We are not too interested in the CCP itself. The CCP is just an intermediary between them. Okay, so let's start the model, and this is essentially the main part, the main contribution, I think, of this work is to come up with a trading model. And the idea is simple because we start with a simple binomial trading model. So what we have is, let's look at a case where we have only 2 clearing members. Now, how can we view trades? So trades are essentially betting or gambling that happens between 2 different entities. For example, clearing member 1 can put $2 in the pot, and clearing member 2 will put $3. And then what will happen is that there will be a trade. So at the end of this trade, there will be some transfer from one clearing member to another. That's how we can view the trade in a basic form. And what we have is that the loss will never exceed the amount. So if you put $2, you will, in the worst case, lose the $2. You don't lose more than that. Okay? So that's the building block. And we look at trades which are fair. So this means that we can view prices of these trades as expected payoffs. This means that if clearing member is putting $2, clearing member 1 is putting $2, but clearing member 2 is putting $3 into the game, then what happens is that clearing member will win with probability 2/5, and the clearing member 2 will win with probability 3/5. So prices are given as expected payoff. Chris, do you have a question?
Yeah.
Okay. And
I don't quite understand the mechanism. Maybe I'm being stupid here.
The mechanism is that, I mean, if we, for example, I'm trading with you, I have $2, you have $3. Now, what happens at the end if we play this game? What will be the probability of my probability of winning, and what will be the probability of winning for each dollar?
You win, what do you get? And what?
if
What are the rules of the game?
what are the rules of the game? The rules
What are
of
you trading?
What's being
you
transferred
toss a
at the
coin.
end?
you know, it's like tossing a coin. Tossing a coin.
Toss a coin, but the coin has an even probability
Yes.
that the game remains fair.
Yes. So let me.
I can understand that as a game. I'm not quite sure I see how this works.
What is the context with CCP?
theory.
If you win the coin flip, do you get the $5?
No, what happens is that we can view each dollar as the ownership of the value after the realization takes place. So if, for example, if you put $2, we put $3, then for each dollar that is in this pot, we will toss a coin. And if
time.
for each dollar we will toss a coin, and then depending on the probability that we have, this coin will be transferred to me or to you. For example, you will have for each, there is $5 now in this pot. With probability 2/5, I will get each of this coin. With probability 3/5, we will get each of this coin.
Yeah, I understand.
So that's basically the main, very simple idea. It's a binomial trading
black
model.
and white. There is
Black
no-
and white,
yeah.
yes. At this stage,
Don't toss the coin for each single dollar. It does the coin for the totality of the amount.
No, it's for each.
no,
No,
you
you
got
got
$1
single
for
one.
each
Fine.
dollar. So I put $2, you put $3.
What's this?
We have
What is-
$5 in this pot, and then there will be some
You
person.
toss 5 coins.
Yes, yes,
What is the
independently
relation
cross.
between
They only
this
do
and
it.
central clearing?
Okay, so that's, but I think that's basically what happens when you trade, meaning you can decompose it at a very granular level, and in the end, every financial contract can be seen as a transfer of.
So can you have any default in this model?
There is no default in the model. Yes.
Counterparty risk without default?
No, there is no counterparty risk. I'm not dealing with counterparty risk. I'm only trying to understand what happens if we trade through the CCP. And assuming that when you trade to the CCP, you post margins and collateral, so that
But you post margins against default, but here you cannot have any default.
yes, but in fact the main point here is not to understand too much what is the reduction in default risk. It's more to understand what happens to the trading value, what happens to the asset value process if we consider like trading through the CCP. So we are not concerned about default risk here.
Trading swaps?
You can trade, yes. You can
That's
trade,
what CCPs trade.
yes.
How does this relate to a swap transaction?
I will go to all this in a great detail. In fact, I mean, I'm starting a bit from the beginning, but this is where I want to go in the end. And
You should let the speaker get on.
no, I think it's a good one, but I started with this because that gives a basic intuition. If I write directly the model for swaps, one doesn't get.
Why don't we have
how
a
we get.
discussion before the
But we can have the discussion.
About what he might say. Yeah, good idea.
No, feel free to interrupt. Maybe I will continue.
Go quickly.
Yeah, okay, yes. Okay, good, so that I can move on. But these are all good questions. So now I have these trading games, right? So the trading is seen as a transfer of ownership from one entity to the other. Now suppose that you repeat this procedure n squared times, and you shrink the tick size. So you make the tick size smaller and smaller. So the tick size is given by the total value. Notice that the total value is basically constant because we are looking at money that is our units that are being transferred from one entity to the other. If we divide this by n, which is the number of periods where we repeat this procedure, then this is considered like the size of the tick. So it doesn't have to be $1, but it can be 1 cent and so on. It can be even smaller than that. If we scale this procedure, then in the limit, we get that this process, the asset value process of each clearing member, will converge to a process which is a Wright-Fisher diffusion process. So this is essentially the limiting procedure. There are details in the paper. If you are interested, we can discuss also during the discussion section. But the bottom line is that we can interpret this sigma, this quantity sigma, in some sense as the trading efficiency of the CCP. Right? If sigma is large, that means that you are trading more often through the CCP for a fixed n. Okay? And the intuition behind this model is that you can really see why we get this intuitively, because in some sense this is the variance of a binomial distribution, right? Square root of v 1 times v minus v1. That's essentially the standard deviation. Okay, so this is essentially the model where we get if we do the limiting procedure. Now, I've started only with a with the model for 2 clearing members, but in a CCP you don't have 2 clearing members, you have n clearing members, right? But we have to keep in mind that when we trade through the CCP, from the point of view of each clearing member, it's like as if he's trading with a big network consisting of all the other n-1 clearing members. There is anonymity of counterparties in the trade. So you don't know, clearing member 1 doesn't know that he's trading with clearing member 5 or clearing member 6. He only knows that he's trading through the CCP. And this is really the key. This is really what we exploit in order to derive the model. We exploit the fact that from my point of view as a clearing member, I don't care who I'm trading with. I only know that I'm trading with a CCP. So that's what.
That's not even true. That's not true.
Okay.
First I do a trade with you, and then we go to the CCP, we clear it to a CCP. I know that I traded with you. I negotiated the price with you.
This is if you consider like novation, right? The
Yeah,
novation
no,
trade-
CCP
CCP equals
CCP.
novation. CCP equals novation.
Yes, but
Lateral trade.
So you're talking about an exchange with the central order book, which is anonymous, but that's not the same as the CCP. Most CCPs we were discussing this morning are not exchanges, they're not anonymous.
they are. Okay, I think in this point, you have a second question one. Yeah, we can discuss this during the discussion.
It's like
but
you're
well,
talking about an exchange.
I'm talking about an anonymity, and I think we can discuss in detail what are the assumptions behind that.
You're anonymous.
But if we look at take advantage of this anonymity practice, then what we have is that basically we can develop a model where each clearing member is trading with the CCP, right, with a big network. So now we have to keep in mind that not all the asset values are traded through the CCP. I mean, if we look at a firm, we can decompose the portfolio of this firm into two parts. There are parts which are used to trade through the CCP, and there is another part which deals with the operational risk of the clearing member. So for example, a bank might have loans, might have other properties such as land, and then they may want to go to the CCP and trade swaps, for example, to hedge some of the risk that they have in their operations. So we look at the total asset value of each clearing member as composed of these two components. One, which is the CCP portfolio, and the other one is the operating portfolio. And along the way, we will impose assumption on how we transfer assets from one portfolio to another. So you can move part of your proceeds from the operating portfolio to the CCP portfolio and vice versa. Okay? That's essentially the picture of how the asset value process of each clearing member evolves. And meaning, if we look at now the joint dynamics of the clearing members, as I said, we can think of the clearing member as trading with the CCP directly. And if this happens, then we have that we can write down the portfolio dynamics of each clearing member, the portfolio dynamics of the clearing member traded with the CCP, which is essentially this right-Fisher diffusion, where V is the total sum in the CCP, the total asset value which is being traded through the CCP. Okay? And here we have conservation of value, which means that we have to impose some conditions on the randomness because everything has to balance, right? There is no money going out and no money flowing in into the CCP. So Barron motion has to satisfy some conditions.
VC is the sum of the VCI, is that correct?
Yes, very good point. VC is the sum of VIC, is the total value, because I'm trading with the CCP, right, which contains all the asset values of the others. And now, what is the model that we use? We have a behavioral assumption here that the CCP is used to hedge the risk in the operating portfolio. So we can look at operating portfolio of each clearing member. Here we are using we are modeling dynamics under the risk-free, using as a numerator the risk-free assets, so we don't have any drift. But what we have is that the operating portfolio will essentially contain all the risk from operations. And if we look at each entity, each clearing member, we can think of this as composed from desired and undesired risks, right? Because each clearing entity will take some risk because it's part of their business. For example, they are trading interest rate swaps to make money, but then they want to hedge part of this risk because maybe they are afraid of counterparty risk, so they go through the CCP and they trade through the CCP. So the CCP essentially is being used to hedge the excessive risk that each clearing member wants to take. So we can see this decomposition in terms of ρ, which classifies exactly what is the desired risk exposure of a clearing member. And so square root of 1 minus rho square is exactly the desired exposure, while ρ is the excessive risk that they are taking. So this is the decomposition. And now, what do they do? What is the behavioral assumption? Is that they want to hedge the excessive risk. So they have some risk that they like, but they have some risk that they don't like. If they don't like this risk, what do? They go through the CCP and they try to hedge this risk by using other instruments such as credit default swaps or interest rate swaps. What does this mean? I mean, if we write down now the dynamic for the operating portfolio, which is consisting of the desired and undesired risk, and then the excessive risk, which is the risk they want to hedge, is also the Brownian motion which is driving the portfolio of the CCP. right? So what we want to make sure, or what the clearing member wants to do, it wants to hedge the excessive risk, which means that they want to remove the randomness coming from their excessive risk in the operating portfolio with the randomness which is generated when you trade through the CCP portfolio. So we want these equations to hold for all clearing members. We want to choose VIC and VIO, the hedging portfolio, through the CCP and the operating portfolio in such a way that this holds for all clearing members. And there is a lot. Chris, do you have a question?
Me?
Yeah, you are.
Yeah, I'm just sort of trying to think what is. So we've got to solve the system of equations. So what are the things that we've got to choose, and what are the things
Yes,
that
that's a very good point. So what we want to choose is the redistribution, the amount that we hedge through the CCP, BIC, and therefore this gives us the amount that we want to keep as operation, which is VIO. The total sum is the asset value of each clearing member.
Is theta fixed in that equation?
Yes, theta is fixed, rho is fixed, theta is the volatility from operating portfolio, that's the parameter here. Rho is the correlation or the desired exposure that the firm wants to take, because it gives exactly the amount of desired risk. If rho is equal to 0, it means that there is no excessive risk. All risk is desired. Okay? And we want this to hold. Now, the first question that one wants to ask is, does this admit a solution? Can we construct a system where we can have this property? And the answer is that yes, you can do that. And key point is to define like a ratio between the CCP portfolio and the total asset value. Then we can rewrite the dynamic of the operating portfolio by looking at this SDE, where if we replace VIO with 1 minus KI times VI, because we know that if we multiply KI times VI, we get the CCP portfolio. But then what is the operating portfolio? It's the asset value minus the CCP portfolio, because we are decomposing it into two. So what we have to do, we have to find an equilibrium, right? We want to find essentially a system of KI, a system of, a set of KI, a set of hedge ratios, so that this equation is satisfied. And this is not clear that it exists, but we can prove that the solution exists and is unique, which means that they only have one choice for redistribution. They can only redistribute the asset value in one way. It's unique. They don't have any other choice. If they want to hedge perfectly their undesired risk through the CCP, they can only do it in one way. Okay? That's essentially an equilibrium. And this means that we can answer the question we started it initially. Can we develop a model where we explicitly take into account the use of the CCP as hedging, for hedging purposes for each clearing member? So can we write down the asset value dynamics? And the answer is yes, we can do that, because as we have seen, there's simply the sum of the dynamic from operating and CCP portfolio, and we know that there will be a unique way of hedging perfectly the desired risk, which leads to essentially the final equation here, because if we sum the variability from operating and CCP portfolio, then we have the hedge equation, which is the fundamental equation, which says that all the undesired risk is cancelled, and therefore the system evolves exactly as this process. Okay, so that was a very important point, because that gives a model that we can use to model how dynamics evolve through the CCP. And the next question is now, can we recalibrate this model? That's, I think, an important question, because when one develops a model, I think it's useless if you don't have any idea of how you can use it. And the way we calibrate this model is the following. We consider a period of 209 weeks. And in this period, first what we want to do, we want to calibrate, we want to estimate CCP portfolio and the operating portfolio. How do we do that? For the CCP portfolio here, I have to mention that we are restricting attention to the ICE clear credit. So we are restricting attention to a CCP which is clearing credit default swaps. So for the CCP portfolio, we are proxying it with the margins. Okay, we are saying that the CCP portfolio is exactly equal to the margins. And this makes sense because, meaning for a CDS market, meaning the contract has always zero value. So when you mark to market the CDS, you are essentially accounting for like collateral that is used to basically to compensate for the change in the mark to market value, and this is automatically recorded in the margins.
So why do you call this the CCP portfolio? The CCP has no position.
Sorry, yes, you're right. Maybe the name is not. The reason why I call it CCP portfolio because it's the portfolio that is used to trade through the CCP. That is the portfolio that the clearing member is trading through the CCP.
Yeah. But it nets to zero if you take all the positions.
If you take, yes, if you consider all the clearing members, yes, but for each individual clearing member, it's not.
The one that is novated, the part of its portfolio that is novated.
Yes, yeah, you can think of this as, right.
I want to know, the margin, is it variation margin or initial margin?
Okay, so the margins here, I will go to this in 1 minute, but it includes all. Initial, variation, anything, any position that is post. I'm not differentiating between initial variation margin. The goal is not to check basically what happens or how to optimally distribute the margin. It's more that every asset that is used to trade through the CCP or that is traded through the CCP is considered to be margins. For example, if you trade like any contract through the CCP, you also post collateral, and this all is the CCP portfolio. It's all the portfolio that is used to trade through the CCP. So it can include performance bonds, it can include other type of collateral that is transferred to the CCP. Okay. Okay. So now I think this is the good proxy that we use for like CCP portfolio is the margins. And how do we estimate the margin? I will show you in a moment, but we use data from the depository trust of clearing corporations, which records bilateral transactions between like clearing entities on CDS reference entities, and we keep track of all this for the 209 weeks, and we will use the method from Duffy and co-authors that I will describe in a moment. For the operating portfolio, instead, we basically use enterprise value. We can take from Bloomberg the market capitalization, look at the long-term debt and short-term debt, give an estimate on enterprise value. We detract from this enterprise value the CCP portfolio, which is estimated through the margins, and this gives us the operating portfolio. Okay, so we have, yes?
I have a question there
Yes.
because, so the counterparties here are broker-dealers.
Yes.
So, so the enterprise value is you're using the fundamentals of say Morgan Stanley or Credit
Yeah, exactly. I'm using the fundamental, right? Yes.
to get the enterprise value.
Yes.
But that may involve things that are not swaps, that are not going through the CCP. Oh, but that's okay.
Yes, because in the end, what I want to do, I want to estimate the operating portfolio. So if I cannot estimate the operating portfolio directly because, as you mentioned, there are a lot of quantities that I cannot observe. But what I can do, I can use the model and say the operating portfolio is equal to the total asset value minus the CCP portfolio. If we believe in this model decomposition, then this gives me the enterprise value. Sorry, this gives me the operating portfolio. Okay, does it answer your question? Yeah. Okay, so now we calibrate the model, and to calibrate the model, we discretize it, and we essentially, because we have continuous time model, but if we discretize and we introduce the variables that we can estimate, which is the CCP portfolio and the operating portfolio, then we end up with this equation, okay, which gives the discrete time evolution of the model. And we have to estimate the margins. How do we estimate the margins? Here we use the method from the margin model that is proposed in a recent paper by Duffy that looks at the delta, the change in the position, which is given by the notional, which is, again, data that we take from the deposit trust and clearing corporations, which gives all these bilateral transactions in the CDS market. We multiply by the CDS duration and by the change in the CDS spreads. This gives us the change in the position value. And once we have that, we can compute the margins by summing up three components. This is not our contribution. This is basically what Duffy has done. He says it takes the initial margin by looking at the worst historical change over time, variation margin, which tracks intradaily changes in the current portfolio position, and then he adds another component, which is the velocity drag, which takes into account that there is always delay when you transfer collateral. So it's not that collateral is immediately transferred. So we can compute all this quantity from this equation, from this quantity, which is the change in the position value, and then once we have this quantity, we can use the GMM, generalized method of moments, where we have like a system of three equations, and we can estimate two parameters of the model, which is the volatility of the operating portfolio and the trading efficiency of the CCP, which is sigma. So here we are looking at this table, which gives us a calibrated estimate, and we want to focus specifically on value of Xi, which Xi is essentially the drift which we introduce when we calibrate, because we are calibrating under the historical measuring. Everything that we have done so far is done under the distributional measure. And this Xi parameter takes into account both for the risk premium and for the capital raising rate of a bank. And we approximate, this is approximately 14% because that's basically empirically what happens if you sum up market default risk premium, market price of risk, which is approximately 4%, and capital raising rate, which can be goodly estimated with like roughly 10%. But again, we have a table so we can change psi and see what happens. And for rho is the desired risk. How do we estimate the desired risk? We look at the ratio between the loans that are held by banks and the amount of gross CDS and the net CDS exposure. So the ratio between the net CDS exposure and the total value of the loans held by the banks, this gives us an idea of the risk that is not desired, right? Because you are trying to hedge this risk. And this methodology is taken from a paper by Minton and Stutz from 2009. So once we have that, then we only have to estimate theta and sigma, and we get statistically significant estimates, which I think we can also nicely interpret, because if we look at this table, what can we deduce? We can deduce some patterns. If we increase psi, if there is a larger like capital raising rate and market risk premium, then we get either theta and either sigma. So why is that? One can think of theta as volatility. So suppose that volatility of operating portfolio. Suppose that the volatility is large. That means that there is a higher probability that some of the clearing members can become small, right? Because there is bigger risk. So then they may want to raise capital at a faster rate. So psi can increase. We can read this table in the other way. Like larger theta may implies larger psi. And also you can think of theta and sigma that are moving somehow monotonically. So if theta increases, if there is higher risk from operations, then we see that we have to hedge it more efficiently through the CCP. So it's like as if there must be more trades in order to hedge this risk. Right? This is what we can see from the graph. And just to give an idea of more intuitively of what is happening here, is that if we take, again, a reasonable estimate for psi, which is 14%, then we can compute the volatility of the CCP portfolio by using the equation, assuming that there is full homogeneity, assume that each clearing member has $1, assume that there are 20 clearing members, that's the case we are considering. Then if we look at estimate that we got, which is 78.4% for theta, and for sigma, and then we multiply this by VI times V minus VI, and we divide it by VI, so we normalize it. We want to compute the volatility of the CC portfolio per each clearing member. This gives us a value of 41.7%. Okay, so again, we don't have to think of this as volatility. This is really the trading efficiency of the CCP. And now this means the following. If we look at $1 of CCP portfolio, right, $1 that is traded through the CCP portfolio, that gives essentially an estimate for the operating portfolio using the hedge equation. So that's why I wrote the hedge equation over there. We can compute VIO by using the calibrated parameters, theta and rho, and the estimate for the portfolios that we have, VIC and VC minus VI. And this gives us a value for the operating portfolio, which is $272 of operating assets. So this perhaps may suggest that banks are being very aggressive, because it means that if you have $272 from your operations, then you are basically hedging only 1% in the CCP portfolio. So that means that the CCP portfolio must be, the banks are seems to be a bit aggressive, right? They are hedging.
I don't understand.
Yes. Yes.
Can you make it, is it a statement that banks are leveraged, or is it a statement that they're not hedging enough? Or, I don't understand the statement.
What is the?
Give me an example, like take a bank.
Yes.
JP Morgan. How would JP Morgan operate here?
How would JP Morgan, if we believe into the model, if JP Morgan is doing exactly this procedure and we are calibrating the model with the data, then we are saying that essentially that the JP Morgan is only hedging, is only putting $1 of CCP portfolio to hedge this $272, which means that the CCP must really be very efficient in hedging this.
But you took
risk.
that value from enterprise value.
Yes.
And that could be hedged differently internally or with other non-clearing counterparties on other things that are not centrally cleared, or
Yes.
be part of.
Yes, yeah, of course, it's true.
The CCP is the only mechanism for hedging.
Yes, that's a good point.
Notwithstanding what JP Morgan might or might not do. I mean,
Yeah,
Thing is that
absolutely.
I think that's more, it says more of the way you estimate, you bring in this non-CCP portfolio. And I actually don't understand why that's necessary, just for the statistical. Why do you need to bring non-CCP assets into the picture?
Because you mean, why don't you model only the CCP portfolio? But then, I mean, then it's not entirely true that the asset value of a clearing member is only the trace that is done through the CCP. I mean, you can think that there are different CCP and you are trading each portfolio.
It's true,
For each
but at the
reader.
same time, it links, it speaks, if you make that assumption, then you speak to, you can investigate how stable is the CCP, because the CCP cannot get assets that are not pledged as collateral in the CCP. So if JP Morgan goes belly up, because the CCP cannot go into JP Morgan's, that's not how it works. The CCP is supposed to collect assets that are already pledged as collateral. So I don't really understand, aside from a statistical estimation procedure, why the non-CCP assets are brought into this picture. And it's kind of confusing. And now you make a statement saying they're not hedging enough. That's even more confusing. It makes it look like they're taking risk.
Maybe we better let the speaker finish.
I think I will be happy to do this. I mean, I have an answer.
I'm looking
that
for the
discussion.
conclusions, to be
Yeah,
able to address the
yes, but I
conclusions.
mean, he's got 15 slides to go. Let's let him make the conclusion.
I will be. I think it's a good. It's a good point, and I want to discuss it in the discussion section. So this. Okay, this means that. I mean, again, if we, and just to go back a bit to your question, also, I mean, if we look now at an estimate of the ratio K-Cap-I, which is the amount that is being traded through the CCP, then we are getting essentially that this is on the order of 0.37% from this statistical estimate. But if you look at an empirical average, if you compute from the data, take the ratio between the margins and the enterprise value, you get a value which is approximately 0.56%. Okay, so that's basically taking real data, real margins, and dividing them by the value of the operation. Okay, so now let me address the final point, which is the market concentration. And here I want to look at what we can do, how we can use this model to make some predictions. So I'm looking at a specific measure, which is the Herfindahl index, which measures the concentration, the level of market concentration. So now in this picture, I'm plotting the market concentration over time by computing it looking at the enterprise value. So I have an equation there for the Herfindahl index. I can do the computation, and once we do the computation, we will see that there seems to be an increasing trend, apart from these big drops, which are due to anomalous events that happened during this period. So there has been a period where, like, one of the banks has lost an incredible amount of equity, which basically made the asset value dropping significantly. It's BNP Paribas. Yes. Good. And the question is, can we interpret like this? Can we explain like phenomena like that? And the answer is the following: meaning, if we use the model, and I mean, remember we have like the model where we have the hedge ratio Cap-I, which gives us a dynamic for the asset value. Then, if the correlation between the Brownian motions, and these Brownian motions are really the Brownian motion capturing the desired risk. So these are the WID in the decomposition. If they are not too correlated, which means it's somehow smaller than 84%, then we get that the Herfindahl index is a sub-martingale, which means that it has a tendency to increase over time, right? So this is what we get. And this means that if the market operates under, say, normal conditions, so it's not extremely correlated, then we get the Herfindahl index is a martingale, which is somewhat consistent with this prediction, with this empirical fact that Herfindahl index tends to increase. Okay, so now what would this suggest? That there is somehow accumulation. I mean, you don't like market concentration because some clearing members might become too large relative to the others. So when the market is normal, there seems to be an accumulation. And one way to prevent that is to inject capital. So we can show that if you allow capital, external capital to be injected into the system, then you can control somehow the market concentration because you can pump up capital when the clearing entities becomes too small. But the question is, do you like that? Meaning, is it desirable? Meaning, if injecting capital, that might basically lead to increasing leverage, right? And this question about leverage basically has been addressed a lot in the literature, and it's not clear that this is what one desires. So what we suggest, I mean, one suggestion could be to break this trade-off between like having market concentration which is increasing and injecting capital by using a self-funded tax and subsidy system. So this means that if we consider like a tax rate gamma 1 and the subsidy rate gamma 2 in a way that like banks are taxed based on their size, if their value of the CCP portfolio is too large, we tax them and we use this money to subsidize the banks which are small, which have a smaller CCP portfolio. Then what we get is that we can rewrite the dynamic of the asset value process, and in this case we get that it's no longer some martingale. In fact, you can see that the CCP portfolio has a tendency to mean revert to the average CCP portfolio. So that means that what one can do is we can choose an appropriate tax rate, or mu, such that the process can be controlled and market concentration can be prevented from increasing, which means we can make the Herfindahl index a super martingale, which means now the concentration has a tendency to go down. Or we can make it a martingale if we want the concentration to be somehow at similar level. So the main point is that basically larger mu, which means higher tax rate, by imposing tax on sites, might result in somehow controlling the level of market concentration.
Herfindahl is F pi.
F-I-N. Okay, thank you, Ron. Yeah, we have to correct that. I always get confused about this name. Oh, no. Okay, so that, I think I ended a bit even earlier, despite the interruptions. And the conclusion is that we give, essentially, what the main point, I think, the really main point was to construct a trading model which explicitly accounts for the fact that part of the trading is being done through the CCP, right? This was the main point. And then we have, main component was to calibrate this model to real data. And then we have seen what we can do, meaning can we use the model to make predictions about accumulation of systemic risk or market concentration. Okay. And okay, this is a set of references that we have used, especially the paper of Duffy has been useful for constructing a margin model, and other papers that we have used either for the estimation procedures or like to build our model. Okay, so this ends the presentation. I have some other slides if you are interested in.
I have a question, maybe you can use your slide.
Yeah.
So what is the problem you're trying to solve?
Yes, okay, what is the problem? The main problem is to construct a model where we can derive the asset value dynamics of clearing members if we account for trading through the CCP. This was the main goal.
When you
Meaning,
mean asset dynamics, you mean the collateral?
Asset value, total asset value process.
Total asset value.
Total asset,
But what does that have to do with the CCP, the total asset value?
because if the question is, you can clearly construct an asset value process by saying, like structural model, classical structural model. Let's assume that this follows a geometric Brownian motion. You can always do that. But if you want to take into account, okay, why do we want to introduce the CCP? First, because I can make predictions. I can say what happens, like to quantities such as the Herfindahl index. If
No, but just come back to the objective. What's the problem you're trying to solve with this model?
okay,
For example,
you mean what?
Are
want to
CCPs
understand-
risky? Are they not risky?
No,
We change the law? Should we propose?
Yes. One clear. Okay, let me answer this question. Yes. Okay. First I have to say. First, I have
Are
to.
they systemically risky? Are they systemically safer?
I'm not okay. So maybe I should have made this point clear
I mean,
at the
let-
beginning. Let me answer the question, and then yes.
Yeah, that's all we want to know.
Maybe I'm not being clear, but I don't care too much about the CCP. I mean, can default or not? It's not a problem here. I'm not caring. I'm not concerned about be too big to fail or defaults of CCP. What I really care is what happens if this regulation enter into play and asset value processing, the dynamics now of the asset value of the clearing members have to take into account that you are trading through the CCP.
But that asset value is an accounting concept.
No, it's not. It's the market value. It's the market value of the asset. It's
The
not an
market
accounting.
value of what?
Of the asset, the market value of the assets,
Very important
I don't understand what asset value means.
okay, asset value.
I'm not being obnoxious.
Let me write
I
it
don't
because.
understand what this is.
Okay, so market value. Let me answer the question. Market value is equal to equity plus debt, right? Now, if you want to look at market value of the asset, you have to look at market capitalization plus value of debt. This is basically the definition of market value. Now you say, okay, why do you have to do all this work? Why don't you just take this equation to be the dynamic of the equations that define the asset value and just do things? That's your question.
No,
right?
my question is,
No.
what is, I mean, I have a hard time attaching the meaning of asset value, for example, for BNP Paribas. What is the asset value of BNP Paribas?
Yes,
What is it? And how is that related to the fact that BNP Paribas clears swaps with ICE or with you know, whatever, with CME? What does that have to do with its asset value?
okay, can you, the question is, how do you get the asset value of
No,
BNP?
my question is, what does the asset value have to do at all with what we're discussing? The asset value of a bank.
Because the asset value of a bank includes assets, and part of these assets are traded through the CCP. I don't understand the question then.
But very little assets of a bank are traded by the CCP.
Yeah, it's true. Yeah, it's true.
0%.
Yeah, I agree. It's not a large proportion. It's a small proportion that
If you're
is
worried
traded.
about a bank going belly up, probably it's not going to happen in the CCP. It's going to happen for some other reason because it did not clear things that are not in the CCP.
Yes, I agree. I agree that your point is that the component of the asset value which is traded to CCP is small.
It's minuscule.
It's small. I agree. I agree that it's small. It's not zero. It's small.
Yes.
So I'm still interested in seeing what can happen if you trade to CCP. Just because it's small, it doesn't mean that you can neglect it completely, right? Because
Okay, so what can happen?
what can happen is, one of the things that can happen is this increase in the market concentration that I've showed at the end, right? If you allow clearing members to trade to CCP, that's what can happen is that if you don't take any action, eventually you can see a situation where some of the clearing members are becoming too large relative to the others because they are gaining a lot from this trading through the CCP.
Yeah, but look at the OTC market,
Yes,
non-cleared. There's huge concentration in the OTC market.
true.
So you cannot really attribute it to this. So I don't see the relation between concentration and CCP. Concentration is present in markets where there's no CCP. Concentration is also present in
Yeah.
markets for assets where there's CCP. But because it's the same guys, it's the same institutions. So I don't see the...
Yeah, concentration, I agree. Meaning, I'm not saying that concentration only arises because you trade through the CCP.
So JP
I'm not-
Morgan is channeling like 50% of all derivatives trades, whether cleared or not cleared.
Yeah.
Is that generated by central clearing? I don't think so, because it's the case for non-cleared and for cleared. I don't see what the link is.
See, the issue of central clearing is
Yeah.
to central clear or not central clear. Derivative trades have been going on since
Yes,
we're all
yes.
graduate students,
What?
bilaterally. And then
Yeah, I'm
all of
not-
a sudden comes someone and says,
Yeah.
shall we central clear? Maybe it's safer.
Yes.
And then they introduced the hub and spoke thing,
Right.
and I thought that your presentation was going to show how you know, this mechanism mitigates risk or enhances risk. And then you brought in the firm value, and I got confused. You estimated something, and then I still remain confused as to whether a CCP is safer or not safe. As far as the banking system, I know how safe it is because I read the Financial Times.
Yeah.
You know,
Yes. No. Maybe
You have an approximation.
going. Yeah.
good one too.
I see your point. Meaning, I agree that there are other reasons for like centrally clearing trades, and I've not addressed them at all. Meaning, I'm only concerned about if you have to follow this rule and you have to do it, then what can happen to the concentration. Now, I'm not like going back also to the question of RAM. I agree that there is concentration in the OTC markets, but one thing that I want to emphasize is that how can you measure like this level of concentration with a model? Can you construct a trading model which,
endogenously through swap trading and profit
Yeah.
endogenously into the CCP?
yeah,
You can generate more people that are bigger than other people.
yeah, yeah,
Bigger positions endogenously.
yeah, that's
Get more. They gain.
yes, exactly. Maybe you can see that also in the bilateral trading market. But my question is, can you construct a model that shows me that?
But you know something.
If you can do that, I will be very happy to compare. It's just that here we can take advantage of the
I will
centralized
tell you,
structure.
I don't know if Duffy's model has this, but any initial margin worth its salt, and there are many of them, has a concentration charge.
Yeah, that's
Also,
good to
it
know.
has a
Yes.
guarantee fund charge that is
Yeah.
directly proportional to how concentrated you are. In fact, some people call the concentration charge a guarantee fund charge
Yeah.
in the CCP. So there's another
Yeah,
amount of margin.
that is accounting for
is
concentration
taken.
risk. Yes,
Essentially, that is, so as this person becomes concentrated,
yes,
this institution,
Yep.
concentrated, its trading, its margin will increase
yeah,
until if it reaches, 100% concentration, it will have to trade with 100%
true.
haircut.
And I think that's a very good point, because meaning
That is, I
what
think,
the
my
model.
takeaway from you.
No, but I think what the model is saying, you can interpret this policy control, right? You can think of how to implement this policy tax and subsidies that I mentioned, exactly
That is, you have to take
by
into
changing the
account-
margins, by charging for concentration risk. That's what
the
it says.
CCP should look at its Herfindahl index. And then its
You can decide, for example, how much of the margins are concentration risk by looking at the Herfindahl index and checking which entities are becoming larger than others by trading through the CCP, and then you can charge them more margins. So this can basically offer an explanation on how you
I
account for
read
that.
some documents from Hong Kong Exchanges and Clearing, and I saw Herfindahl index in there, but I didn't understand what it was. So now, with your talk, I have a better.
Actually, I was not aware of this document, and thanks for pointing this out. But that's essentially one way that we are thinking we can implement this.
Yeah, it's a control for the CCP.
Yes. But yeah, question.
Yeah, I mean, first, I mean, because I think with the, do we have an idea with the full development and implementation of EMIR, eventually, what proportion will be centrally cleared? I mean, that's true that today, I mean, it's a small proportion.
Today is more
But
proportion, yes.
I mean, are we going towards more than half of the market will be centrally cleared?
Well, I have slightly out of date information on that.
Mhm.
I mean, first of all, no structured products whatsoever, right? So, for example, in the swap market, it's just pure fixed floating swaps, right?
Okay.
And there, as of last year, I
About
think,
CDS as well?
CDS, yeah.
CDS, yeah.
CDS.
Yeah.
I don't know the statistics for CDS,
Mhm.
but for rates,
Rates, yeah.
it's around 1/3 is cleared last year, and it's rising.
It's rising, yeah, no, because
It's
eventually.
rising because it has to be
and the-
100%.
the-
yeah.
There are 4 phases.
Yeah,
But
exactly, yeah.
I mean, for swaps, I mean,
But it's a long way to go, is the
Yeah.
point.
Mhm. Because the question, I mean, right, I was trying to, if you can say, a few words on why if there are this limit. So you had this limit of 1/2 for the correlation. That's below this level of correlation. The index is rising.
Yes.
And so what's happening above? And what that means that we have this type of concentrating index until the correlation becomes too high.
If the correlation
And then you get this
big jump down, that
come down, and so
that will okay.
what the dynamics globally.
Let me explain. Yes,
The other
this
thing
one.
is never bring up the word tax in the context of broker dealers because they're never.
And I want to answer this. Yeah, it's a good.
Call it SAT or whatever,
You're referring. So you are referring to this slide, right? What happens?
Yes. Yeah.
Okay. So let me give some intuition. So what we know is that if the system is not too correlated, so they are not all trading exactly the same quantity, or they are not all exposed to exactly the same risk factors, then there will be a tendency to increase. Now, I don't know what happens if rho is above 84%, but for example, if you think that the correlation is 1, so if they are fully correlated, then what would happen is that the market diversity would stay constant, because every one increases, the other also increases. So if you take the ratio, it doesn't change. So then that seems to suggest, but again, I don't have any proof for that, that if you are below this level, yes, then there is a tendency to increase. If they become very correlated, it might converge to be a constant. But what happens between this 84% and 1, we don't know. And then,
Because
and I,
when you look at the behavior of the concentration of markets when you have crisis,
yes,
what you see, I mean, physically you see bubbles
yes,
forming up.
I completely agree. Yes,
The markets tend to concentrate,
and I think this is a
then
very
the
good,
bubbles blows,
yes,
And then, of course, during the blow, the
concentration might
might
drop.
100% correlated.
Yes.
But afterwards, again, it starts, diversified, etc.
True,
And,
true.
and you
Yeah,
know,
but-
the
but-
2001,
but
the 2008.
But that has
and then-
nothing to do with the CCP, right? Again, we come
No,
back
no,
to
no, no,
this.
no. It's just but he's studying, generally speaking, an endogenous price process. That's exactly. And that's
So I think if you
actually it's
remove
related
this-
to your talk in Rio.
Yeah,
you
I
might
think if you
mention something
remove the
different.
CCP in the bottle,
Yes.
you don't lose anything, but you make it actually maybe more.
Okay, but let me ask.
I have
What's
another
the
idea.
CCP to do?
Take
This is what I
away-
don't get.
Okay, I think I should make a very important point, which is actually the basic why we need to take advantage of the CCP clearing trading structure. You are essentially trading, and I want to answer your first question about the anonymities, the fact that there is anonymous trades. So if you trade through the CCP, what I'm saying is that if I trade with any person that is interacting with the CCP, I actually don't care whom I'm trading with, because I'm only trading with one. And CCP actually may be exchange, right? That they can take the task of finding the counterparty for you.
So what you-
there is, I think it's
is an
anonymous.
exchange.
Yes.
But
Are exchange?
it's not an exchange. Most CCPs are not exchanges. They don't have to do exchange.
Do you want to add something? Or?
It is the case that Dodd-Frank was designed to make exchanges and clearinghouses into CCP.
Yeah.
So regardless of what commercially is out there, the CCPs that we should really care about right now, and the ones that are reformed into working as CCPs, those are what we think of as exchanges, like the fixed floating CDS stuff. Those now act as exchanges.
No, they're not
No.
exchanges.
Some-
This is not
No,
correct. This is not
no,
correct.
that
There's
is
a
false, that is
confusion
not
there.
true.
CCPs are not exchanges. You trade bilaterally.
Yes.
I agree with you on the phone that I'm going to trade a swap contract with you. Then we move to the clearinghouse, and the clearinghouse will manage the cash flows during the lifetime
Will
of the
novate.
swap
Will
to make
novate.
sure that nobody defaults on their payments. But they don't even know the price at which I traded with you. This is not revealed. Unlike an exchange where prices are posted publicly, there's pre-trade and post-trade transparency, and you know the order book. In a CCP, you don't know who traded with whom, how much. Only the two parties know their position and they trade. So it's a big difference. It's not anonymous. So exchanges act as clearing parties, but not the other way around. So I think
So
what
I
you're
think we
talking
should
about is
say
an exchange.
Exchanges that act as clearing parties.
Yeah. So
Yes, because not all,
These are different
not all trades
entities.
come from
An
Novation.
exchange is a computer where you put limit orders. It's a matching book.
Yeah.
A CCP is like a financial institution.
Yeah.
Yeah.
It's which has a legal framework. It probably has some backing by the central bank, and it's supposed to be the back office of all the trades, which the exchange could also do, and it also serves to manage the collateral. To put collateral like the DTCC. So it is a very different concept than the exchange. For example, for exchanges in the OTC, you have the Sept, swap execution facilities, and for clearinghouses, you have two. You have LCH and CME for interest rates, which have nothing to do. And LCH is not a swap execution facility, and CME has a swap execution facility or not. I don't know.
No, I think to the extent that you can think of CCP as an exchange, yes, I agree. That also. But what you are pointing out is that not all CCP are exchanges. And then
No, they're different things. It's like not all blue jeans are, socks. They're different things.
There is, for what you say, Marco, there is a very nice, if you go to Wikipedia, the article on Wikipedia on, I'm trying to remember, is it on, I think the article on not Virginia, but it's clearing something. It's on a clearing house or something like this. And there is a diagram which I show in my lectures because I have a lecture to teach exactly that. And there is a very clear diagram with you see when the order is passed to the exchange, where it goes to, and
Okay, good. We'll all go to
We'll
Wikipedia.
go to your talk.
There was another question here. Can we?
No, I have a completely different perspective on this.
Thanks.
You could think of this problem as, does the firm decide to trade customized bespoke transactions, instruments, or standardized transactions, right? So you can say, even the way the rules are, at least in the US, standardized ones are clear,
Yeah.
non-standardized bespoke ones are unclear. So
Yes.
there's like an unclear as per. And so when I was listening to the discussion here, thinking back to Robert Burton wrote this paper on innovation spiral, right? So you have sort of these bespoke transactions. At some point, they become very standardized. They become building blocks for other more complex structures, right? So the issue is the choice you're making. So when a firm is, let's assume a customer calls and says, I want to hedge this crazy export,
Yes.
right? A longer dated, like, a 5-year crude oil hedge. I have a choice. I do the trade, then when I turn around, do I go to the future space and trade the Brent or on the exchange, or do I go to the OTC market and find a counterparty to sort of trade the similar contract, I guess. So that's a different. So I'm not sure if your paper is sort of what you're talking about is in that construct. But when I'm listening to you in the conversation, that's the thing. That's what happens in the real world,
Yeah.
right?
Yeah.
There's always a choice
It's a choice.
between, do I trade this custom product and try to find a hedge, or do I use the building blocks and manage it in a very dynamic manner?
Yes.
That's the choice that the firms are taking all the time, and that's where they make all the money.
Yeah.
You mean in the latter choice? They make.
Yeah, absolutely.
Yes, it's a good point. I mean, the correct mean that what is driving everything here is that you are using one of the part, which is the CCP, exactly to hedge the risk. Now, if you have this decomposition into bespoke, like customized products that you held in your balance sheets, and others that are more standardized that you trade to the CCP, the question is how are those related? Right? If you are using the standardized products to somehow hedge part of the risk that you have in your balance sheet, I think that's certainly applicable. Yeah.
Now, or another thing is, suppose I have a book of derivatives, very
Yes.
quickly. Which am I going to novate and which ones I am not going to novate?
Yeah, I think the novation part of it is second order in some sense.
And which
right?
are essentially clear and which are not?
Yeah, so once you design on which product you're going to be trading, so they don't care about whether it's $0 futures or interest rate swaps and whether it's clear, right? It's like the clearing is to take care of the counterparty risk and the operational risk issues.
Yes.
I'm just trying to figure out where I can find a liquid hedge, which I haven't priced. What I price is the unhedgeable sort of risk which I need to manage against. So the liquidity is what you care about. That's first order risk, and then the fact that it's clear or unclear.
There's a very interesting thing because of, if you look at, for instance, interest rate options, which is an interesting subject, some of them are very customized, some of them are very standardized. And therefore, before, certain dealers, they kept them all together. They did the exotic trade here, and they kept this, but they did not centrally clear. And now the idea is, one of the issues is you have to central clear, the most plain vanilla of these options, but then now they are committed to a different margin, so it increases, somehow it has implications in terms of the amount of margin. I think that most people really think here of, they're going to make a profit. Profit is out of the equation. Every time you make a trade, a dealer makes a profit, and that's it. It's not a speculator. It's a dealer. So it's mostly the margin cost. I think that it's a margin cost thing, and also it's a risk because it's a risk because they also have to take care of risk.
And on top of that, I want to add that I think that's certainly valid what you mentioned, but also CCP I think are used only for proprietary. I mean, there is no the Dodd-Frank Act mandates that all trades that you drew through the CCP should not have a speculative purpose.
We never know what's speculative or not.
No, but
is that,
very hard
what I'm saying is that from
Right,
the point of view of a dealer, who knows?
no, that's the reason why you don't capture this.
No, what I'm saying is
Profit
that
and
from
loss.
the dealer's perspective, he makes money on every trade. So
Yeah.
what he has to think about, this is the way my opinion now,
Yeah.
personally, is that how much collateral do I have to do to make $1? I have to put a lot of
That's a
collateral.
good
So
note
really-
on which to close this session, I think, and continue perhaps over
Okay.
coffee and tea. And we'd like to thank the speaker for an interesting paper, which has certainly provoked an excited discussion. So thank you very much.